Thank you very much for making a date and welcome back. Now, the Monetary Policy Committee of the Bank of Ghana has reduced the policy rate significantly. The central bank dropped its key lending rate to commercial banks by 100 basis points to 22.5%. This is the second reduction for this year after the biggest rate cut of 200 basis points in March this year. The development could lead to further reduction in the cost of credit in the country. Governor Dr. Ernest Addison said the move was influenced by a favorable economic outlook for the country.
The committee noted that the pace of economic activity has picked up, driven mainly by growth in private sector credit, improved business sentiments, and easing credit stance. Furthermore, increased oil production from the Jubilee and 10 fields and the coming on stream of further activity in the oil and gas sector from the fields by the third quarter of the year should give added impetus to overall growth prospects. In sum, there is evidence to suggest that economic imbalances that existed at the end of 2016 are giving way to stronger fundamentals, with growth to pick up strongly in the period ahead, although it will remain below potential. The 2017 budget indicates a return to the path of fiscal consolidation. The reduction in the fiscal deficit for the year is expected to foster more stable macroeconomic conditions. Rigorous and steadfast implementation of the budget will therefore be critical to the outlook. On inflation, the committee noted that headline inflation and inflation expectations have broadly trended downwards. The disinflation process has been supported by tight policy stance and exchange rate stability. With a stable outlook for exchange rate movements and return to the path of fiscal consolidation, headline inflation is expected to trend towards the medium-term target in 2018, barring any unanticipated shocks. Given these considerations, the committee judged that the downside risks to growth outweigh the upside risks to inflation in the outlook, and therefore decided to reduce the policy rate by 100 basis points to 22.5%. The committee would continue to monitor risks and take the necessary policy actions to move the headline inflation towards the medium-term target. Thank you very much.
So that was the governor of the central bank, Dr. Ernest Addison, chairing his first Monetary Policy Committee meeting, which today was held at the Bank of Ghana, and of course witnessed a significant drop in the rate from 23.5% to 22.5%. We will be getting some more insight into this and also possibly come up with a comparative analysis of previous years' policy rates and its impact on the economy. All right, so you're still on the marketplace, and right here joining me in the studio to do some more analysis is economist Aseye Akotia from Nordia Capital, who is going to throw some more light on the current development and also look at previous years' policy rates and see the impact. Good afternoon, sir. Welcome to the show.
Good afternoon. Thanks for having me.
All right. So, now, how do you make of the new policy rates?
It was very much expected. It's very much in line with this previous government's administrative policy, which is a private sector-led economic growth. Okay. The cost of credit has been very critical, and in time past, the cost of credit has been so high, which is very much hitting the industry. And so it's very clear from day one, right from January through to, as you rightly heard, or you rightly said, 100-year basis points going off the previous rate. Is very much in line with what the policy for the government is.
Now, 200 basis points was what we witnessed in March. Yes, in March. Now 100 basis points. Does the difference make any way at all for the economy?
Yes, we're not expecting a similar 200 basis points. You realize that after 200 basis points, inflation rate went up a bit. That's in the last month. And, there's a fine balance between the policy rate and inflation. Mind you, our monetary policy tool is inflation targeting. And so you need to watch it carefully. And so we're not expecting an aggressive 200 basis points. Honestly, I was expecting a 50, not 100.
Okay.
So it shows the level of aggression. And we all know this governor from his previous work with the central bank and elsewhere. It's more aggressive in driving such policy. So 100 basis points, I would say it's very much welcome.
Now, the governor mentioned favorable economic outlook. I remember he said oil and gas activities also was taken into consideration.
Yes,
Do you share exactly the same opinion, especially when we have not witnessed any production from Sankofa?
We have not witnessed any production from Sankofa yet, but mind you, the economy is, usually expect the economy to be proactive. You have an outlook, what we're expecting as an economy or industry. If we believe that outlook is good, it reflects in decisions we take today. So I think it's very much on point when he says economic outlook is good. Goodwill, for instance, has been very much with this new government, and everybody has rallied, to push the agenda of making the industry work again. We've come out of a very tight monetary policy, and even with the new administration coming on board, you realize that you even have some markets willing to even cut prices, even though they bought these items they are cutting prices on now with a higher price. It all comes to goodwill and it all comes to the outlook. So once the economy feels that there's something good in the near future, that we begin to be more, we don't react, but we kind of take the step.
But normally, does the economy react to such, policy rate changes? I mean, over the years, some commercial banks have still not been too keen in reducing their lending rates, even though policy rates have changed.
Yes. Policy rates has changed consistently downwards. Inflation has done same. Treasury bill has done same. But question, you go and look at some base rates of certain banks, and it remains the same, or the rate at which it comes down is not as much as these indicators coming down. Well, the banks, I believe that the banks are playing a wait-and-see approach, even though they have a formula that very much determines how the base rate should be priced. Mind you, a lot of these banks will be telling you that in recent times, once you have the foreign investors being able to purchase our treasury bill, you have 80% of it being purchased by foreigners. And so the downward trend in treasury bill doesn't really reflect what the average investor here is looking out for. But I believe it's a matter of time the banks will be forced to go along with these current indicators, and cost of credit generally will dampen.
Let's now take some retrospective analysis of past or previous years' policy rates. Now, before this government took over, we had been witnessing increments in policy rates, and now it's an opposite direction. What should we learn from this, or what should we be happy about?
The beauty of economics, it's a matter of policy and it's a matter of ideologies. What you believe should be the way forward with these indicators. The previous government, though we are all practicing inflation targeting, they believe that if policy rate goes up and treasury bill goes up accordingly, you mop up the excess CDs in the system, and therefore you dampen inflation. And you can see an opposite approach from this current government. And for me, it seems to be winning. It seems that this current approach is doing the trick. So I'm likely to be more inclined to what we are witnessing now on the market. I believe that we go this way and the desired results will be achieved.
So when we take a look at the previous rates, over the past years, it's kind of assume a roller coaster, levels. It was up and it comes down and then it looks like going up again. What's the trend? What's interesting about this trend?
You see from March, May last year, we went to 12.5, 18, go up to 26, come to 23, and now 22.5. If you express this as against other indicators, I'm sure for instance, if you add what the CD currency depreciation or appreciation is, you see a similar trend also with the interest rates on treasury bills. There's a correlation between all these three indicators, be policy rate, interest rate, and inflation. And so this don't move on the move and the others follow. So that if a monetary policy rate moves in a certain direction and it doesn't seem like the other indicators are following quickly, as a monetary policy committee, you could come back and revise your rates and reverse it, just not to, as it were, dumping what you expected, the kind of reaction you're expecting. If you watch the trend, you would have realized that if you do it, like I said, against the currency markets, you realize that the months where we went down and came up, it was a way of kind of cutting back on what the CD was depreciating against the dollar. That's the trend you establish if you put this against the currency.
So what we have, for instance, November 15 to September 18, a red margin moving up.
26.
26. I mean, does it mean that the economy was so bad at that time? The indicators were so bad at that time.
It wasn't, I don't want to say it was that bad, but it wasn't very good. I mean, last year, look at what happened to the CD getting towards the end of the CD, getting to the end of the year. It seemed to be stabilizing a bit, getting towards December, the election time, and interest rates also on the Treasury bill started dampening. But at that, you would compare December and January, and you realize that policy rates started coming down. But at the time, from November, if I started from September through to December, through to November, you realize that the CD was not performing very well. So it had a very negative effect on
Now, do you have any hope that this particular trend will be sustained, I mean, over the past few months that we've had?
Yes, we are hopeful that this trend will be sustained. I'm waiting to see what inflation rate will be for this month. Inflation was going down, the rate was going down and went up slightly to 13 percentage points year on year. If inflation comes down or stabilizes, we're expecting this trend to stay.
Wow, interesting. Now, before you go, can you give us some analysis on the markets? How is the market going, the capital markets? I mean, do we have some good performance of the stocks?
Yes, the stock market for this year has been fantastic. On the back of 2 years back-to-back negative return, we already have a year-to-date of about 13% on the general index, and the financial stocks doing averagely, I think, about 16%. And the outlook is good. Once you have an alternative money market, rates trending downwards, you expect the stock market also to be a bit more bullish. So we expect the trend right now to continue, what we are seeing on the stock market.
However, for this week, what should we be looking at?
Last week, we had some block trades, and the market ended on a very positive note. We expect the market to stabilize a bit. Usually after a block trade like this, I think in Guinness, Ghana or so, we expect the market to stabilize a bit. And so this week, I don't think we expect too much activity. Probably some few banking stocks, maybe a Cow Bank, and maybe a petroleum stock like Goil. I expect that last year ended positive. I think Goil led the market gainers last week, I beg your pardon. And I'm expecting just some few percentage points or price appreciations on the stocks. But generally, we expect this week to stabilize after we had massive block trades in last week's capital market activities.
What about the currency market?
Yes,
the CD still doing well against the dollar?
Relatively, yes. If you compare to a few weeks ago, you would say not very well when the CD seemed to be on the high and flying very high against its major trading currency, the dollar. But like anything that is determined by the market, it will stabilize. I believe it stabilized. The gains that were gotten from the back of the issue of the bond, the $2 billion bond, I believe is stabilizing now. So we expect the CD to stabilize. I don't think that upward run that we experienced in the past few weeks would continue. If it would, not in the immediate, probably in the mid to long term, latter part of this year, I mean. But immediately, I expect the CD to stabilize and averagely 4.3, 4.4, not ending the week not too different from how we started.
All right, finally, a look at the commodities. This morning I checked from Bloomberg, and it looks like the commodities have begun picking up. Like, for instance, crude oil prices, Brent crude, is now within the range of over $50,
yes,
54.
54, yeah.
Yes, sometime last 2 weeks or so, it was quite lower. Now, would this impact any way on our market here?
It should, but I'll be quick to say I believe that for crude oil, you know, OPEC in the second quarter, OPEC, those are the major oil producing countries, plus even some of the non-producing countries intend to dampen supply or production. And if that's happened, I don't think that the upward run on crude oil prices will be sustained. I actually expect it to dampen a bit, slightly. And talking about other commodities, say gold, the Asian markets, most of our exports in gold goes to China and India. And if you have the Asian markets, especially China, trying to decelerate a bit, I expect that also to hit gold a bit. So for me, outlook on crude commodities also on gold is not the very best. I expect to stabilize a bit, but rather I think the pricing on crude might go up because if this the production is cut, then it does go up. If it goes up,
that would be good news for us.
Yeah, that would be good news for us.
Very soon, I heard that Sankofa has made a record flow of oil. Yeah, sure. All right, thank you very much, Asseyi.
Thank you.
For your time.
Thank you. My pleasure.
Okay, so that was Asseyi Akotia. He's an economist from Nordia Capital, and we've been talking about the new the policy rate announced by the Monetary Policy Committee, which now stands at 22.5%. Moving on the marketplace, the country's debt stock has increased by 5 billion cedis in just 3 months to reach 127 billion Ghana cedis. That's according to the latest economic and financial data released by the central bank. Is this a sign that government is losing the fight against containing rising public debt? George Riafe has more on this.
The significant increase in the public debts in just 3 months has raised questions about the effectiveness of government's plan of reducing the rising public expenditure, despite several policies like debt reprofiling to contain the situation. The 127 billion debt stock recorded is still higher than what was posted in the same period of 2016. It's accounted for more than half of the total debt stock. But sources close to government insist the increase didn't come about as a result of fresh borrowings on the part of this new administration, but rather the city's depreciation in the first 3 months of this year, some payments that were already arranged by the previous administration, which were made in the first quarter of this year, that resulted in a significant jump in the debt stock. The source adds measures instituted by this administration to contain the debts will be seen after June this year. However, when you look at the 127 billion Ghana cedi debt in relation to the size of the economy, it has reduced to about 62%. This could lead to the country being removed from the list of countries that might have serious challenges in paying its debts on time. On the banking front, the data showed that the industry wasn't doing that bad, despite reports that some 9 banks are in serious financial distress. It showed strong growth in lending to the private sector, deposit attraction, growth in assets, and also marginal reduction in loans that banks fear might go bad. The amount of money the country has to support imports in case of crisis has reached $6.3 billion.
And meanwhile, an economist, Professor Peter Quartey, tells Joy Business government needs to do more if it really is committed to dealing with rising public debts.
We haven't seen a decline in the debt stock, but rather some increments of our $27 million. If we are fighting against debt to ensure that the debt figures are reduced in the next 4 or 5 years, then any increment, in my view, is not something that Ghanaians will welcome. But having said that, if the debt GDP figures we are seeing is something that can be confirmed, it's a massive decline in debt GDP. What it tells you is that perhaps the debt is being invested, and GDP, we are increasing GDP, and that, for me, is a good signal. But one has to be cautious with this figure because I cannot confirm any GDP figure for March 2017.
Now, the Asantehene Otumfuo II is advocating the utilization of the Petroleum Heritage Fund as collateral by banks to support farmers expand the agricultural industry. He is optimistic this will be a more appropriate approach of expanding the private sector as well as helping to address unemployment. He adds it will also boost the economy and prevent over-reliance on the country's oil and gas resources. The Asantehene was speaking when the leadership of the Ghana Chamber of Commerce and Industries paid a courtesy call on him at the Menchia Palace in Kumasi.
Government has recently launched the Planting for Food and Jobs program. We should be thinking of how we can invest in the agri sector. If the banks can't help much, what should we do? We can use the Heritage Fund as collateral for the banks at lower interest rates to support the industries.
At lower interest rate, industry in Fanya. Nina between a boama, a muabai.
All right, so that was Asante Hene 2-4-82. It's still on the marketplace. Let's take a quick break here. We'll be right back with more. All right, now, you're welcome back. Now, the Chamber of Commerce and Industry is meeting with industry players at the Alisa Hotel right here in Accra to explore best ways to make government's one district, one factory policy a success. Trade and Industry Minister Alan Kyerematen, who earlier spoke, was hopeful the policy will generate between 500,000 and 1 million jobs by the end of the year. Now, our correspondent Charles Aite is currently there at the Alisa Hotel and is joining us live with some updates. Charles, you're welcome.
Thank you very much, Emmanuel Bajuwafi. So we are currently at the Alisa Hotel where the Chamber of Commerce has, brought together various industry players in the wake of the One District, One Factory policy, which is yet to be launched somewhere in July. And great news for industry players, those who would love to be a part of this very program, because the head of the Ghana Commercial Bank is promising a 1 billion cedi, in terms of funding for each and every businessman and woman who would love to be a part of this very program, as well as that of the Trade Ministry under the leadership of Alan Kyerematen, who has also pledged government support, towards the private sector in that regard. But I do have here with me the Chief Executive Officer of the Chamber of Commerce in person of Mark Bedu Abuaje to help us understand his own appreciation of this very forum right here at the Alisa Hotel. Thank you very much, sir, for honoring this very interview here on Joy Business. First of all, your impressions about today's forum.
Yeah, I think it's been a very good program. I mean, the room has been overflowed with major stakeholders. So it's been a very good program. We've got all the important personalities here to talk on the issues. The Minister of Trade is here. The Deputy is also here. We have the MD of Ghana Commercial Bank also with us here. We have an expert in value chain analysis here. We have somebody who had worked with this One District, One Factory also here to share their views. And if you look at the question that people are asking, you realize that the people were actually looking for clarification on a number of issues, and I think we've been able to address that.
So what were some of the key concerns that most of these businessmen and women raised during this very forum?
Yeah, the key concern, I think one was the government involvement in this whole project. People wanted to know the extent to which government is involved in this project. If government is coming in, is it coming in as an equity participant, or is it's giving a loan, or is giving money free to people? And it's been clarified that the maximum participation that the government will have is about 30%. The 70% of it will have to come from the private sector. Even with the 30%, it could be less than 30%. One key issue was the issue of value chain. I think people wanted to know what are we doing differently from all the industrialization policy that we have had that failed us over the years. What are we doing differently to make sure that this policy succeeds? And I think that the value chain analysis had done that particular work, because we realized that over the years, whenever we want to do some of these industrialization policies, we don't do a proper value chain analysis. So we will start, and in the middle, we get stuck there. But here we are doing a value chain right from the start to the end. Who is providing the raw material? How is the marketing going to be done? Who is manufacturing? Who is providing other support services? So we are looking at all these things to make sure that we have a very successful One District, One Factory project.
Let's talk about the timeliness of this very forum, because we just heard from the Bank of Ghana that the policy rate has been reduced by 100 basic points. This comes as good news to most businessmen and women. How is the Chamber, appreciating this very reduction?
Yeah, I think it's a very good news. I was just talking to some other colleagues, and I was asking for a reduction up to 20%. but I think it's okay. We will take the 1%. I think the environment is now very conducive for a further reduction in the policy rate. All these things feeds into the one district, one factory. Somebody was asking whether with this one district, one factory, we are going to have interest rate at 30-35%, which will be extremely difficult for a manufacturing company. But if you're seeing the policy rate coming down, it means interest rates are also likely to come down. We are also urging the commercial banks that now that we have this conducive environment, policy rate is coming down, the TB rate is coming down, they should also follow suit to also reduce their interest rate, all in support of the manufacturing sector and the economy at large.
All right, thank you very much, sir, for your time with us. So that was the Chief Executive Officer of the Ghana Chamber of Commerce. And so, Emmanuel, you did hear that from him. And as we are here at the Alisa Hotel, it's right to understand the fact that all these concerns that he has raised together with other industry players at the forum are going to be channeled through a formal communique to government that's going to be through the Chamber of Commerce to the Trades Minister, the Trades Minister, Alan Tremantin, in that regard, for governments to review them and come up with the best policies to ensure that the One District, One Factory policy, the flagship program under this new administration, is successful.
Thank you very much, Charles Aite. Charles Aite joining us live from the Alisa Hotel, where the Ghana Chamber of Commerce and Industry has been meeting industry players on the implementation of the One District, One Factory policy by government. And on that note, we wrap up this afternoon's edition of the Marketplace. Many thanks for your company, and do join me again same time tomorrow for another interesting edition. My name is Emmanuel Abuaji. Good afternoon.